Welcome back. The October home prices posted the biggest gain of 2023 despite mortgage rates, this said by Case Shiller S&P Index. What we're going to see though is that the housing market is facing multiple challenges. Number one, rising prices with high interest rates. Number two, the velocity of sales are slowing. And then, of course, there's also mortgage spreads, which remain quite high. First off, the news of the day. S&P Case-Shiller Home Price Index rose 4.8% year over year. That is really good news. We can see on a year over year basis in yellow 4.8%, 4.9% on a 20 city home price index, month over month rising as well. And we can see on a short term basis, meaning over the past year or so, the home price index and the 20 city home price index both marking very significant highs. These are the highest highs we've seen in over a year. However, if we zoom out, it's a little bit of a different story. Blue bars show us a home price index year over year basis. It is true, it has risen quite a bit, but we're still well off the highs that we've seen for quite a while. Now, the yellow line is the 10-year US Treasury yield. And notice there's a little bit of a delayed reaction. When the yield goes up, the home price index already is starting to fall. Conversely, when the yield drops, the home price index is already starting to rise. So we can see the peak of the home price index occurred 2020, 2021. Now, of course, this is on a year over year basis. Comparing these figures to the COVID crisis is a little bit unfair. Nevertheless, we did see the peaks as treasury yields were rising. Now, with very high treasury yields, we see, well, the home price index is rising, but it's coming off very, very big lows. Now, compare the home price index to the S&P 500, this case in yellow. By the way, the S&P 500 is not very far off from all-time highs. So keep that in mind as we close out the year in trading. Notice overall there's a positive correlation. Stocks tend to go up at the same time as a home price index, and conversely, when one index goes down, so does the other. But this gap that we see now here is kind of troubling. A lot of us analysts and traders are asking ourselves, is the stock market going to return down to match the home price index, which is well off the highs? It doesn't make sense how stocks are very, very close to reaching new all-time highs, whereas the home price index is at such significant lows. Home price index year over year compared to the federal funds rate, this time in yellow. Low interest rates certainly do help out the home price index, but we see now with high interest rates that certainly has done its job at suppressing inflation. But unfortunately, the home price index also participates in inflation. So, issue number one is the fact that the home price index we're reaching highs. The prices of homes are going up, but they're going up in conjunction with very high interest rates, which is making it very difficult for home buyers to buy homes. Number two, second issue, we spoke about this yesterday. The new home sales, this is the velocity of homes sold, and this is in thousands, hit 590,000. Now, this is the very significant low that we saw in quite a long time, going back about a year or so. So, this is the second issue, that the velocity of homes are being sold has gone down dramatically, whereas the prices are going up, but it really doesn't matter if prices are going up if nobody's buying. Issue number three, we also spoke about this yesterday, mortgage spreads, which represents the difference between the 30-year mortgage and the 10-year US Treasury bond. Now, typically, again, we'd expect a 30-year mortgage to mimic the 30-year Treasury bond, plus or minus a little bit because it's a mortgage. But this does vary, the relationship between the 30-year mortgage and the 10-year Treasury. Why? Because when there's economic calamity out there, the banks will add in extra premium as insurance because a bad economy means that more home buyers may not be able to pay their mortgage. Well, mortgage spreads on that note typically widen during or prior to recessions. Well, this is what the mortgage spread looks like right now. The blue lines represent the difference between 30-year average mortgage, 10-year US Treasury. So despite Treasury yields coming down, which they have indeed, mortgage spreads still remain quite high, which means if we can visualize as the 10-year treasury is going down, and the 30-year treasury to an extent is also going down, the banks are not lowering their average mortgages as much. They're keeping them also pretty high. They're keeping them higher than with what we would normally expect them, to do based on the direction of the bond market. So point being is that the banks see trouble in the future. And of course, we also have the issues of high home prices, but not a lot of people are buying. And those who choose to buy are fighting very, very high interest rates. Three different challenges intersecting the housing market. How these challenges develop will certainly determine whether we have a soft or hard landing. Stay tuned for more updates as the story continues to develop almost on a daily basis. We hope this has been helpful. We look forward to seeing you back soon.